Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can see what we see in the global landscape for 2016. Well, of course, 2015 is officially over. Most of the indexes around the world were negative anywhere from 1% as much as 35 to 40%. I'm glad to say our clients fared the pullback quite well. In fact, most of our client accounts fared it exceptionally well compared to the overall market. While we never like to see volatility in any of our managed accounts, we know that short-term volatility is a natural part of investing. But again, we look at the major indices for last year, almost everyone was negative and many double-digit big percentages. That wasn't our clients. We're looking for a much better 2016. Generally speaking, the U.S. economy is doing well. There's still turbulence, of course, around the world. I expect the Fed to raise rates again this year, maybe 1 to 3 times. Probably not much more than that. It'll be data dependent. But I feel that the U.S. economy is in a growth spurt. We should be growing faster, and I've repeated this many times throughout the last 3 or 4 years, that our GDP is growing around 2 to 2.5%, and we'll probably grow that for 2016. But we should be growing north of 3.5 to 4% if our government had stable policies in order to promote business growth, employment growth, and growing the overall U.S. economy. But that's simply not the case. Maybe the next president will implement better strategies for our economy to grow faster. And if that happens, that means earnings are better for corporations. Potentially the stock market could go up quite a bit more, and investors ultimately will be richer across the board. Remember, the better the U.S. economy does, the better often the U.S. stock market does and investors do in general. We expect rates to stay relatively low through 2016, but go up slightly as the Fed raises rates. That will cause bonds obviously to be negative. By the way, last year, long-term treasuries, 20-year plus treasuries, were negative over 2% year to date last year. So while the stock market was down between 2 and over 35%, depending what index you look at, the bond market, in addition, the treasury market, many of those were negative on the long dated. We avoided long dated treasuries, and I would continue to look at short-term, safer short-term investments in the fixed income side, in addition to staying mainly U.S.-centric in the equity markets. We plan on making a few more adjustments in 2016 to better our performance for our clients overall and also to manage risk. If you're a client of our firm and you have any questions whatsoever, please call the office. If you're not a client of our firm, call the office, make a consultation appointment. It's time you became a client. And of course, clients, we always appreciate your referrals. Make sure you have yourself a safe and profitable day.